Welcome to the Money Huddle, a podcast that discusses financial topics for families, retirees, and small business owners. Hosted by Michael Baker and Ross Marinell. All opinions expressed by Michael and Ross or any podcast guests are solely their own opinions and may not reflect the opinions of Advisory Alpha. The podcast recording is for informational purposes only and should not be relied upon for investment decisions. Clients of Advisory Alpha may maintain positions in securities discussed on the program.
Hey everyone, thanks for joining us. My name is Michael Baker and I'm here with Ross Marinell, and we've got a special guest with us today. His name is Jon Lohr. Jon is a chartered financial analyst and he works with us. He is in our home office, the mothership up at Advisory Alpha. And so Jon, welcome to the show, man.
Why, thank you. Thank you for having me on.
We are pretty excited to talk about some CFA stuff today. You know, use the big words and all of the technical jargon. I'm kidding. I don't want your seat heating up too quickly. All right. But Ross, I know you got some stuff to kick us off with. So what's the latest?
So before we get into some nitty-gritty stuff with Jon, I saw this article come across recently. It said Florida is set to require high school financial literacy class to graduate. So in order to graduate high school in Florida, you're going to have and pass a financial literacy class. Michael, what do you think about this?
Well, I personally am super biased because I feel like this is a no-brainer. I did take a peek at the article and I saw it passed unanimously, which to me it's why are we not doing this? I mean, our central tenet of our entire economy is that people understand how money works, the basics, and the fact that we aren't teaching that in schools, I think, is a huge miss on our part. So hopefully lawmakers will take heed from this and it becomes more commonplace as part of the core curriculum.
All right, something stuck out to me in this article. So reading what the curriculum is, it says this will provide a foundation for students to learn about the basics of money management, understanding debt, understanding how to balance a checkbook, and understanding the fundamentals of investing. Our young people don't even have a checkbook. They don't have checks.
I know.
Like, we've got to bring this. I love the concept, but please, Florida, do this right. Bring it to current terms and what people are actually doing.
Well, I think I definitely agree with that. My thinking is that the idea of it is so outdated. Even now, when I have conversations with people, they'll say, "Oh, people don't need to know how to do balanced checkbook." And I'm like, folks, like we don't write checks. Like, that's not what we do anymore in finance. So I think that the positive thing is that they have the curriculum. They have made this part of the curriculum. And now the easy part, in my opinion, should be to get this curriculum evolved and like caught up with the current times. That's where I'm at with it.
I agree. So one more thing, we're going to talk a little bit about interest rates today with Jon. Mm-hmm. And one of the big components of this story has been, well, what's happening not just with treasury rates, but also what's happening with some of the mortgage rates. And so I saw this post come through. This was Mackenzie Bezos. So Mackenzie Scott, my apologies. So ex-spouse to Jeff Bezos has reportedly donated $436 million to Habitat for Humanity to help with some affordable housing. Michael, I did a quick scan of Fort Mill, South Carolina, looking for homes under $300,000 that were for sale. There's 2 townhomes. That's it. There's no affordable housing inventory any longer. It's just evaporated. And I think what a great time for her to make that investment. I hope they can really deliver something wonderful for people who need a place to live. They don't have $500,000 to fork over for a mortgage loan.
Well, my understanding that like Habitat for Humanity, and I could be wrong with the scope of everything that they do, but most of the time when I've heard, what they do typically is they come in and they refurbish, they revitalize homes for people that are in need that may not be able to necessarily, or they'll build like, little houses. So I think that, that's going to be huge for them just as a nonprofit to have that access to that capital. But I don't think that that's going to solve like the real estate woes for a lot of people because interest rates and inflation and cost of materials and just population migration. It's a real thing. It's happening.
So,
So
John, we've got to bring you in at this point because mortgage rates are that's one component of this interest rate change that we've seen that people resonate with because it's very apparent, right? You're seeing interest rates. We saw 30-year mortgages in the twos and low threes for the low point, now back into the fours. So people are becoming a lot more aware what's happening with interest rates. We see them rising. So we want to dig into this a little bit with you. I know you've done quite a bit of research on the topic. It's certainly a focus as our investment committee is meeting, and you're doing research for our portfolios to be thinking about how interest rates are going to affect liquidity, how they're going to affect business in the economy. So just give us a little primer, John, just to kind of introduce, what the yield curve is, how it can affect people's daily lives, and kind of just get us started off on that topic.
Sure. So, well, we're having a transition in the economy, I would say, and interest rates kind of help regulate that transition. The transition got kickstarted off probably through the inflation that we're all hearing about and starting to experience. And I think, as you noted, the inflation in housing has been pretty incredible. I mean, there's been a pretty sizable rate up in house prices, and we'd also now we're also looking at potentially higher prices for food and energy, particularly gasoline. Um, so we, with this is kind of a function of I would say money working um, a little bit too hot in the economy. So
Right.
as the interest rates rise up, we can probably expect some of these rapid price appreciations to start to cool off. And just to cite a statistic, and it's a national statistic, kind of on home price, or represents a home price index, but year over year, the Case-Shiller home price index appreciation is running about 18%. That's over a 12-month period. So I would suspect, and I wouldn't say that we're going to experience a housing crash because for all we know, that those price increases that have gone into housing are in. That's
Right.
kind of the new level of money that's floating around in the economy. And but I would say with mortgage rates rising, like you say, and mortgage rates are benchmarked off government yields. So if we can kind of safely assume that if you see government yields increasing, what the government pays on their debt, if we see those yields rising, it's probably correlated. We're also probably seeing a correlation in increasing mortgage rates as well. So those higher mortgage rates will, I would suspect, begin to kind of slow the growth of price appreciation we're seeing in certain essential goods, housing being one of them. Energy and food are kind of that's a very complicated, probably different subject.
Right.
Yeah, so that's what I mean by interest rates will kind of start to begin to regulate certain aspects of certain aspects of the economy where we see inflation.
I agree. And so when Fed Chairman Powell had his the sort of big announcement of their rate policy, what was your initial thought on that? Because I think your take was a little bit different than the consensus that was out in the marketplace a little bit.
I'm happy for it.
Yeah. Explain that a little bit because I think some people might have been taken a little surprised by how hawkish some of his statements were. I think the market was kind of oscillating between maybe 3 to maybe a few more rate hikes, but they came out pretty strong and said, look, we're going to take a pretty steady path to raising rates. And just kind of dig into why you think that was a helpful outcome or could potentially be helpful for our U.S. economy.
Well, frankly, I kind of get the benefit of hindsight now because I have seen what has happened to our inflation numbers. And I really want to go into too much into like the recent past to kind of set it. But as far as I can tell, is I think the rate hikes again is kind of being a moderator on price increases is going to be highly relevant for the future. So basically, essentially, to protect against runaway inflation and really, hurting the middle class and lower class of the American economy, damaging expenditure growth. Like, if we don't get a tap on inflation, American dollars are going to start to go. I mean, are just going to get eaten up by the essentials that they need in life. That's gas, food, shelter. Um, so so obviously, I don't.
So
I don't. Yeah, go ahead.
I was gonna say, why don't can you elaborate on that a little bit? Because like in my mind, like I'm thinking, okay, is that not a good thing if the dollars are, it almost sounds like higher prices are the cure for higher prices because they'll consume what they can, but they'll consume less of things. They'll start making different choices, which
Hmm.
will eventually, create some pressure relief on some of these areas that have been really tapped. I don't know, but it sounds like when you're saying, hey, people are gonna, they're gonna use it to eat, or they're gonna use it for gas. Then they're not necessarily gonna be buying, you know more durable goods repeatedly over and over and over again.
Yeah,
um,
that's exactly right. Like, I think like economists like to use this term elasticity of price,
right.
and so what that essentially means is like um, how sensitive are we to the amount of goods or services we purchase based on the price changes that move through a certain segment of the economy.
Hmm.
And so when it comes to like the essentials of life like food and shelter and energy, we're pretty what they say inelastic.
Right.
We require a certain volume of that or quantity of that no matter what the price is.
I don't know,
So
man. This, it was cold this morning, and I didn't turn my car on to like warm it up for the kids before we went to school. We were Spartans this morning.
so you do have some
I did.
elasticity
I
of
did.
demand
I
there,
was
but
like, and the gas is like $4 a gallon. It's like, yo, better put another coat on.
but
You know.
generally, like when when areas of the economy that surge in price that we really can't. I mean, over the long term we can make adjustments, but over the short term, when we can't make adjustments as fast, we're going to be extremely sensitive to where we can make adjustments. We're going to be very very sensitive to that. So that could be like our travel plans, or our the consumer goods we choose to buy. um, so
And I always think about small businesses when we talk about inflation and being able to get the products that you need at a reasonable price to complete whatever service that you're offering. So if you're an HVAC contractor or a general contractor, when I see inflation numbers start to run away on lumber and raw materials, that gets concerning because obviously that puts pressure on those businesses to get their materials and deliver them without having to raise prices on their consumers across the board. And so if we don't get control of inflation, like you mentioned, prices just get to a point where everything becomes a challenge. Gas prices go up and you have 20 trucks in your fleet that you have to fill up gas in to drive around and service people's homes. Then you have no choice but to raise prices. And so I think your take on the Fed's decision, or at least their announcement in their last meeting, was all right. They're taking a more serious approach to getting this under control now.
yes, I think so. Yeah, and another reason I like to see some changes. I mean, this is not just the Fed. This is global. This is central banking across the
Right.
globe. And we did have governments and sovereign economies did have a crisis to manage. And we are kind of like right at the beginning of the payback of that crisis, as we're seeing through the inflation numbers. It's probably all good. I mean, I try, I try to be an optimistic, and it's probably all good. Like, we can manage this. It's just the adjustments are a little bit shocking, happen. But another reason why I like to see kind of the interest rate policy changing is there's this when essentially when it comes to the yield curve or like a government, the rates of interest government debt pay. There's various yield curves denominated in all types of different currencies like US dollar, yen, euro. But let's just focus on like our domestic economy because our treasury bonds are kind of seen as is basically safest assets in the world that actually pay coupon or will pay dollar.
Right.
We'll focus on that yield curve. But the strangest thing about interest rates, I would say, the great financial crisis of 2008, is money just had to be just continually lack of a better word, pumped into the economic system
Right.
to get prices to preserve price stability, which is one of the mandates of the Fed, to get prices to be fairly stable and ideally have some desirable level of inflation in the price level. But to do that, it was a great manipulation with interest rates. So in normal circumstances, what you would want your government bond yield or your government interest rate to do is basically keep you on par, we'll just say simply, with nominal GDP growth. So I'd like to let's just almost even more simple than that, maybe, is just make sure that when I own a government bond, that the coupon it's paying, the interest rate that it's providing, is keeping me on par with inflation, or it's not. I'm not losing purchasing power by being
Right.
having my money stored in
Right.
that asset. Okay, so that's primary principle number one. And then primary principle number two is this idea of different levels of liquidity. And it's very simple. Like, if I'm going to lend my money out longer, like 10 years versus say 1 year, ideally I should probably get what you might refer to as a time premium for taking greater levels of uncertainty. There's more uncertainty in a 10-year period than there is in a 1-year period.
Right.
Theoretically speaking, I mean, experience might say something different, but it's so anyhow. Where I'm trying to go with this is with like a lot of the extremely low interest rates we've experienced over the past 10 to 12 years, and these experiments called quantitative easing, where central banks are buying assets out of the marketplace. What it's done is it's distorted or disrupted or created some friction, however you want to maybe describe it, of the term premium, where essentially as an investor, I'm no longer getting an extra interest rate spread to lend my money out over longer periods of time. I think what the Fed and other central banks are trying to get to is get back to a period where there is actually a liquidity premium, where you are rewarded to lend your money out over a longer period of time. And that's healthy for money, and that's healthy for a financial system. And that's one thing I'm very encouraged to see, because government yields, as far as an investment, as far as calculating value on something, value is something that pays cash flow.
Right.
And we're all very in finance. We're all very interested in determining what the net present value of all future cash flows are. And so, getting back to a place where purchasing power is, where I can, if I put my money in an asset, it will keep me on par with inflation. It will preserve my purchasing power, and it will also give me, whatever the market's rate determines it is, but it will give me some level of interest rate reward for lending my money out longer and taking greater uncertainty with it. So these are why I'm very encouraged with like what is happening in the interest rate environment right now. I think it's going to be a great equilibrator of like normalizing prices. The price hikes that have come in, they may be in.
Right.
I mean, certain sectors of the economy are going to be different than others, where the price hikes are going to stay, and other sectors might be more sensitive to as demand is more elastic
Right.
to the move. But yeah, getting the concept of an interest rate and time value of money working back in the economic system again, like in kind of a text back scenario. I find that very healthy for money. Yeah.
Right.
I'm gonna take the other side of that. I mean, I agree with everything you said about the technically being accurate, but here's the problem that we have here in the U.S. Like, number one is, like, even as low as our rates are, if you look at them compared to like global like sovereign debt, it's not even a comparison. Like, we're still the safe haven. And so even when rates try to go up here, if they rise too quickly, they're going to be auction. I mean, there's going to be downward pressure on yields because the demand is going to be so strong, I think globally. And then, at the same time, we're running about, the financial crisis, but I mean, we had COVID. But if you remember back in 2018, once that they tried to raise it to 3%, the federal funds rate to 3%. We had a 20% sell off in like a month, and then they had to back off a little bit because that was too strong. And in this circumstance, they are going to be trying to raise rates and run off their balance sheet simultaneously. You know, and I also think there's a lot of political pressure on the Fed because the inflation is part of the Fed's mandate. And, the politicians on both sides went and voted to spend all of this money, create all of this money. And now they're wanting to get the Fed to put the genie back in the bottle. And I think that it's going to take some time to sort itself out. I feel like if we go too quickly, then essentially what you're doing is you're saying, to heck with equity holders, people that are investing in our capital markets. Now they get to take the pain so we can, try to mop up the mess that was in some ways self-created. So I'm not sure like that we can get back to this historical rate where, you've got people buying again the safe assets, if you will, air quotes over safe, in treasuries, being rewarded for that. Because if you look, where else is there to go? If you go into cash, you're negative. If you're trying to buy foreign bonds that are, sovereign, bonds, you're likely have negative real yields. So the only way you go is you go U.S. treasuries, or you go high yield, and then you're introducing risk, which is not what you would be doing for a safe asset. So I'm not really sure how we get back to a normal interest rate policy unless there's just something really significant that takes place. I'm, and again, I could be wrong. I agree with your answer. I just don't know that we can get there without somebody making a policy error.
Well, and I think probably the less humans interfere with it, and they just and the more like
Oh,
the less intervention that I mean, there's going to be some level of intervention on the short. I mean, the Fed governs the very basically overnight interest rates, the
right.
rates that banks are charging to one another on reserves. That's basically what the Fed is regulating. Anything further out on the curve, like the 10-year Treasury government bond, is mostly, I think, dictated through market forces like supply and demand. And so the supply and demand aspect of of longer term dated yields, I think you're correct. It's going to be a very long, arduous process of what's ahead. I actually kind of what you were talking about foreign demand for our for U.S. Treasuries. I think that is actually a really I mean, actually, I don't even really have to think about it because I can almost look at so we are our country's we have a record wide trade deficit right now on goods and services. They call that the current account deficit. on the current account deficit, there has to be another side of it called that's used to finance the import of those goods and services. That's the financial account.
Right.
So when we have a current account deficit, we have a surplus on the financial account, which means well, well, excuse me. I want to say, this, don't want to screw this one up, but uh, well, it means we're exporting U.S. dollars. Okay.
Right.
Yeah.
So, and those U.S. dollars, I'm pretty sure are coming back into U.S. Treasuries, and so there's a segmentation part of the yield curve happening there, where foreign demand is buying like a U.S. Treasury 10-year and hold and putting pressure on that yield from not going too high, right? Like it's a bit, the demand comes in for that yield, and price goes up, yield goes down, right? Okay, the inverse relationship there. Anyways, so I think there are I actually kind of I'm just thinking about like what that is doing to the yield curve today. On the one hand, you have the
Mhm.
Fed at the very short end increasing rates, and then at the very long end, you might have a lot of demand. I don't know where it's whether it's domestic or foreign demand. It's just a lot of demand for long dated U.S. Treasuries, which are holding yields back over there. So you're getting sort of a in certain, well, let's just describe the slope of the yield curve today. We have low interest rates at the very front end at the 1 month, and then the interest rates increase quite quickly out to about 3 years. At the 3-year yield is currently about 250 basis points. So it's a very steep rise from like 1 month to 3 year. But then from like 3 year out to 10 year, the yield curve is very flat. And that flatness may be representative of a lot of demand coming in for those treasuries and holding those interest rates back from rising as quickly.
Right.
From rising as quickly, or from preventing the yield curve from being normal. Um, I can say I like to imagine almost that is kind of a bullish scenario, because
Right.
there is that almost is telling me that there's a lot of demand for long-term investment in the United States economy. And as we take that capital from foreigners, or from even from our own domestic investors, we can do things with that capital. We can, build on technology and build on, improving industry and investing in our infrastructure. And I think that is very positive for our, it creates jobs and is very positive for our economic activity going forward. So, even though
Well,
there is, yeah, go ahead.
I was just going to say, remember too, I mean, and we've talked about this, offline, and it's just, there's so many different variables at play that it's a bit mind bending to try to think you've got a grasp on the entire complexity of the situation. But I mean, if you even think about just here in the U.S., like how many workers are still contributing to their retirement funds, and those inside of a 401k. And like one of the most common things people do now in 401ks is they buy these target date funds, and part of that target date fund is going to go and buy a certain percentage of U.S. government bonds, like ongoing. So there's like, I don't want to say
Mhm.
that we've created like a floor for like the stock market or any one particular asset class, but I mean, a lot of these funds now, they have like a set mandate and they run on an algorithm. There's not like a man or woman behind the curtain saying, you know what, I don't really like the yields on the US 10-year right now, and I think there's some interest rate risk, at play, possibly some volatility. So instead of doing that, I'm going to do this. No, the computers are just going to do what the computers do. And more and more things just continue to be automated in that way. And I mean, and you look at a lot of the free or cheap or whatever you would describe them, like platforms that are now available for people to go in and just buy their own things online. I mean, it's becoming trading and investing in the market has become ubiquitous since COVID, I think. I mean, it's kind of everywhere. I mean, we can't watch the NCAA tournament without seeing, the QQQ commercials. And it just kills me that, like, I'm watching this. But, so I mean, I'm thinking, like, one of the things that I think, like, the three of us, we could sit in a room and we can chop this up. But let's look at it down. Let's try to distill it down and, like, talk about what this means for, like, real everyday people. And, one of the things that I think most people are feeling right now are two things. One, obviously the inflation bug it's hitting everybody, because it's hitting food, it's hitting groceries, it's hitting, gas prices. And, and even if you think, oh, I'm not really that impacted, gas prices impact everything. And then now we have this war going over in Europe that's going to impact energy prices. So you've got that. But the other thing is that we've got a lot of people that are conservative, that are a little older. They're not looking to take huge risks in the market. They may not be as excited about a generational buying opportunity as younger investors might be with the market pullback. And those folks are struggling because they've got, more conservative assets, and inflation is now running 7% year over year. And they look at their bank account and they're getting 0.01% in their savings, where they're getting marketed to the new high yield CD rate that might be 1.5%, for however many years. And they just have some heartburn. So, I mean, how do we see this playing out for those folks? And what are some ideas that they may want to consider as far as looking at their overall investments, looking at their plan? What are your thoughts on that, John?
What are my thoughts? Well, my thoughts are, if for the older generations that have made their money, if they have enough money that they feel like they can run their lives out with, I congratulate them. That is a very comfortable place to go, a very comfortable place to probably be, and it's kind of a goal for all of us that are involved in the financial planning practice and to help our clients get there. If you have, I think in an older generation scenario, and assuming you have a pretty big sum of money saved, it does warrant and give you kind of the luxury to not have to take risk to grow a financial account balances or to compound on savings. And you can move into, ideally, like I said, the treasury rates in current times have been probably doing just enough to keep financial savings on par with the rate of price increases on average in the economy. And so what do like, if I look at the inflation rate, that includes components for food and energy in it, and take an average over the past 10 years, I don't know what that comes out at, but that probably comes out at like 2.1% on average a year or something, is the type of inflation we've experienced over the past decade. Going forward, I don't know what will happen to that average. The market seems to be forecasting that inflation uh, beginning 5 years out from now will be at about 2.3%. Okay, so if I take those if I kind of anchor onto those two figures, somewhere say around 2.25% inflation is maybe what my expectation should be on average. And then I start to, again, if I'm not looking, if I don't need to take a risk to, um, preserve a certain level of lifestyle, or or reach a certain level of lifestyle, then, I can look at the government bond yields and say, what are supposed to be guaranteed yields, and say, okay, what at least keeps me on par with inflation. And I don't know, I'll just, the 10-year, I guess today it really had a pretty sizable run up in the last 24 hours here, but we're almost at 2.5% on the 10-year government bond. So I guess if my best guess for inflation is 2.25 over the next 10 years, and I can make an investment that pays me that level of interest rate, I should at least be able to have some comfort then that my financial reserves in my bank account are keeping pace with the, a general basket of goods and services that I might be participating in the economy. I think with older people, it gets a little bit trickier too, because their medical expenses
Right.
are probably a higher proportion of their budget, where that and so medical inflation can be a lot different than general economic inflation. But
So do you think, I mean, what do you think? So if you're saying like we're at the 10, I mean, we're now, I mean, how much room does the Fed actually, in your opinion, how much room does the Fed actually have to fight market rates? I mean, if market rates, I mean, if the market's already putting the 10-year over 2 and 2.3, 2.5, I mean, obviously they've got room in there to raise, right? They've got room to raise, for looking at the 10-year. But I mean, if we're looking at the 10-year kind of staying somewhat, being able to hold where it's at now and hover around 2.25, 2.3, and they're saying, hey, we'd like to be at 2.9 by the end of the year. I mean, how feasible is that really? I mean, that doesn't leave any wiggle room for them, and it also implies that the yields don't go back down, which I think the market's gonna constantly put downward pressure on yields, just because right now, especially with the instability overseas, where are you going to put your money?
yeah, so
Stocks.
no,
I mean, hold on.
Yes,
I,
there
I
he
think
is.
hold on, because one, I think the option at this last meeting was either they came out and were soft and dovish on rate increases, the Fed I'm talking about,
Right.
and maybe there's a short term rally, but the long term realization sets in that we're not going to get a hold of this. Like, we're not going to take any strong measures to try and reel in inflation and bring prices under control. And as much as we may not like what's happened in the past, certainly some of the decisions the Fed made are completely defensible and probably help save the economy in some ways. But then we just get over the top. Like, we do one stimulus package for COVID, which is essential, absolutely necessary to keep small businesses and homes afloat.
Right.
But then we do the second and the next, and we just keep piling on. And if we don't at some point pull things back, then the inflation discussion becomes, at some point, it just really starts to hurt the economy. So
Yeah.
I'm thinking along the lines of what kind of John's initial reaction to Powell's speech was. It's good because at least we're addressing the problem, and we're taking some more serious steps to curb inflation, which we have to have, or as John mentioned, the lower and middle income families are just going to get priced out. I mean, priced out of home buying, priced out of car buying, priced out of any discretionary spending beyond your food and energy.
and it's
So
going to hurt them.
my side on that is, and I don't disagree. What I am maybe trying to state differently is, I don't know that the solution is the Fed's got to risk running like major policy errors in doing things, versus like how much of it is a supply issue. I mean, how much of it, I mean, these are questions I don't know the answers to, but these are the questions that I ask myself. Like, okay, we talk about affordable housing. Well, I mean, just here where we live in South Carolina, they put a $18,000 impact fee for the schools to build a new house. Like, so you can't, I mean, you got to be able to eat that cost if you're a contractor, and then you've got to be able to eat it so that you can then pass it on to a home buyer, right? Well, how many other obstacles are being placed either through zoning ordinances, taxes, impact fees, regulations, infrastructure or lack of infrastructure is taking place where, hey, we've got housing problems because we can't build houses. And then even if we could build the houses, now we've got supply chain issues with materials. I mean, there's so many different pieces of the puzzle, and I am not in that place where I feel like we should let the sun rise and set with whatever the Fed decides to do, because that is a very dangerous place to be from an economic perspective. And then on the other hand, it's now we introduce, to me, the political side of it, because you got a lot of politicians in DC on both sides, this isn't a one side or the other issue, that voted for these stimulus bills that now are seeing, economic realities play out, that are going to want to put pressure on the Fed to do things a certain way to try to abate inflation so that it can appear that things may or may not have, been taken control of by the time they get to run for office. And I feel like that is just not the way you do monetary policy. So I feel like we're in a weird spot right now. And it's just, to me, I agree that we need to be raising rates. I'm not saying we shouldn't. I'm just saying how aggressive should we go? I mean, yes, we already know that the Fed's behind the curve, but does it make sense for us to try to catch ourselves up, in 6 months, in 8 months? I don't know that I'm there,
Yeah, first thing, the Fed is they're not really trying to attack interest rates. I wouldn't frame it that way. They are they're following they're looking after their dual mandate, which is full employment, which I would say the box is checked there.
Right.
Labor market seems to be
Easy.
3.8% unemployment
yeah,
rate.
yeah. So, and then inflation is the second part of their mandate, or price stability. I should say it that way.
Yeah.
And that's gotten a little bit unwieldy right now, which is the purpose of the rate hikes. And again, it's not the Fed; it's central banks around the world are doing the same thing. In fact, I think the United Kingdom's interest rates are higher than ours right now, which gives strength to the British pound. So what essentially where this inflation comes from is it comes from credit expansion. Ultimately, I would argue that it comes from credit expansion in the banking sector. So when the market supply and demand forces, and also through the Fed's movement through policy, what we're essentially doing is we're either hitting on the gas pedal of credit expansion, or we're tapping on the brakes of credit expansion. And right now we're getting into an environment where we're tapping on the brakes. So we talked about the yield curve shape a little bit just a moment ago. And from a bank, from a financial savings and loans market, it's very essential for these for entities or agencies that are involved in those markets to earn an interest rate spread. They do that by borrowing short and then lending long. And so when there becomes a disincentive to borrow short and lend long, all of a sudden that will slow down the type of credit expansion or the credit growth that is coming out of the savings and loans market. And I think this is probably what we're starting to recognize and experience. I mean, to get back on the housing topic, is what we're starting to recognize and experience in our economy right now. What we have right now is we still have low interest rates, making it very lucrative for financial institutions to borrow and to expand credit, but they're only probably start expanding credit only out so far as that interest rate spread makes sense, which right now it's starting to look like 3 years. So very short duration lending and borrowing activities are probably still quite healthy in the economy. Like there's probably still a lot of credit creation going on in the shorter duration segments of the market. But now that we're starting to exhibit a flat yield curve, and potentially a yield curve where the longer term interest rates could fall below shorter term interest rates, the lending practices, the credit expansion practices of making long-term investments from a financial institution standpoint is still no longer starting to make sense. And I think as a result, like we are, higher more. I mean, this ties into we're seeing less probably mortgage activity go through. So, for example,
Yes.
I looked at the national statistics yesterday on mortgage applications and refinance applications, and mortgage applications are down. They're still quite healthy, but they're down relative to 2020 and 2021. That makes sense because there was massive credit expansion in those 2 years. And then
how much, how much demand, like in it, just like we would talk about anything else. I mean, how much demand was pulled forward because, rates went down. There was,
a lot,
people refinancing, and then, a lot of people decided after 2020, hey, you know what, being locked down in a city where I can't go anywhere, do anything in a, 2-bedroom, 2-bathroom apartment's not what I want to do anymore. Let me get a mortgage and get the heck out of here and go to the suburbs.
Right.
I don't know. I mean, these are
I
these
think
are
a lot of
things that I just
activity
asked
was.
myself.
I
What?
think a lot of activity. Oh, go
Hey,
ahead,
Ross,
John.
can I jump in real quick?
Yeah.
One last thing I just want to say why I think it's I just wanted to finish up here and just the whole credit expansion on like using mortgages as an example, like kind of slowing that down, tapering down. We start off talking about home price appreciation, tapering down that home price appreciation growth is because it trickles into or it affects rents as well.
Right.
So, when house prices start getting out of reach of the typical buyer, the alternative is to look for rent. Well, when those prices go high, it's not a pretty, it could get to an ugly picture. And it's not, I don't want to say that we're in an ugly picture, but it could get there, so I'm
Yeah.
sorry. Yeah.
Well, and I mean, another thing that happened though during COVID, I mean, if we're going to talk about market distortion, is how many landlords just got left hanging. I mean, where they just said, hey, people don't have to pay rent and you can't kick them out unless they're like destroying your property or, but you can't kick them out for failure to pay. I mean, there's just so many things again that happened that when we try to isolate even just one area of the market like housing, there's so many other factors that took place in that one spot, which is why it's like I guess my great overarching concern is that people get in, there's been decisions that have been made, some wheels are in motion, and that the human urge, right? Just as investors, the human urge is to get in there and fix it. And some things you can't just fix. Like you have to like let things kind of play a little bit, and see how things are going to. I mean, for example, California is giving people stimulus money. They're rebate checks, right? But stimulus money because of gas prices. Well, what do you think these people are going to do? Buy $400 worth of gas? $500 worth of gas? No. A lot of people are going to go buy something, So, anyways, we've beaten that topic down pretty good. Any final thoughts, Ross? John?
I think, John, you talked a little bit about the yield curve. We've seen kind of the headlines or the warnings, like, is the yield curve going to invert? Where like you said, it sort of disincentivizes lenders from extending credit on a longer time horizon. So far, that's not happened. And there is still a little bit of a spread between the 2-year and the 10-year. We're seeing even shorter comparisons, like between the 3-month and the 5-year, which I think is a little bit, which is applicable too, right? Because if a bank's taking a deposit and then lending out on an auto loan or something where they expect to be repaid in a few years, that spreads remained. It's shrinking. It's definitely getting tighter, but it's not inverted yet.
I don't know, buddy. We might have 10-year car notes before long. These $100,000 SUVs. I mean,
yeah, we might
Interest
need.
rates will take care of that.
I'm here for the 10-year financing option.
Listen, we may need a 10-year car note to pay these. It doesn't mean you're going to get one.
I was looking the other day on a car app, and it was just going through financing options, and I saw there was an 8-year financing option.
Wow.
8 years.
But I think, though, just to kind of get back to, I don't really care whatever the government's decisions or faults or whatever. It's not in our control. What is in our control is how we help people manage their portfolios going forward. And I think the takeaway that I'm starting to get more comfortable with is that because of the current Fed stance, I think it actually may help us in portfolio management going forward than if they were soft. Because at least this creates a little bit more certainty as to what's going to happen, and I'm not as concerned maybe now about stock investing as I was even a month ago. I mean, any thoughts on that, John, that you can kind of shed? Because I think portfolio, this is obviously what we do, right? Is we have to focus on how do we kind of steward people's finances through their retirement. And I feel a little better today than I did a month ago.
Hmm. The one thing I think stocks have an advantage in this environment, even though it is kind of, choppy and uncertain. We've watched equity markets do what equity markets do over the
Sure.
past, I guess really frankly 2 months. Kind of got a little, but really, I mean, even back into, I would say 6 months, 12 months.
Yeah,
Right.
it's been a lot longer than most people realize.
Yeah.
This sideways action in the market's been going on for a long time, which is why I think a lot of people are just exhausted. I mean, from it, because it's like every time you feel like you're getting, all right, hey, we've got our feet underneath us. There's been other stuff that's happened. So,
I have a anecdotal theory of why we're all exhausted. Maybe I can share it later, but not right,
no,
not
share.
right
You
now.
got to share it now. You can't say that on
Well,
air and then
the
like,
reason
no, I'm not going to say it.
economically, I tend to frame things all economically just because that's what my nature.
That's the
That's what
best way to do it, buddy.
it's I mean it's just what I part to do. But economically, why we're all exhausted or why we all feel exhausted is because we've been through a whole business cycle in a matter of a 24-month period.
Yeah.
Normally, a
That's what I
business
said last
cycle lasts about
podcast. Like,
yeah.
it's literally the fastest roller coaster. It's hard to process. We were locked in our homes 2 years ago.
We
Yeah.
saw economic expenditures or prices contract in COVID and quickly expand through the stimulus and through the programs set forth to rescue the economies.
Well,
Um,
but even consumers though, you think about even just from a consumer standpoint, like our energy costs have gone up, but last year we couldn't really go anywhere and do anything. So people were just buying stuff. And so,
yeah,
you know, like I said, we just had Elizabeth's been wanting to do some stuff with our house. So she had a decorator, an interior decorator or designer come over yesterday and visited with her. And she was telling me, we were kind of doing like a little post game wrap up after she got done meeting with this lady. And she was telling me, you're having to book a book. You're having to book these guys, these contractors to come out and do work like months in advance. And Ross, and we know people that are in this business, right? That they're like, yeah, we're putting people on the calendar, but we're not getting to them for months at a time because the
yeah,
backlog is so steep of people that have wanted to do work on their homes. And then I think the next iteration of that is what we're going to see this summer, spring and summer. Is like it's going to get warm and people are going places. They're
yes,
going places. They're going to go do stuff. They're going to take trips. They're going to catch up for being stuck inside for 2 years. And I mean, barring like something completely unforeseen happening, most states are going to be opened up and open for business. And so people are going to be back, heavily, traveling and doing the experience side of things. So we've kind of gone through the buying stuff, the home renovation stuff. Now we're getting into like the going and doing and experiencing stuff
yeah.
part of the cycle, I think.
I think that's true. I think that what another thing that's been so interesting about the pandemic's experience, an experiment, is the
Don't say that.
lessons that.
Don't say pandemic experiment. YouTube will kick us off.
Oh yeah,
That's
yeah.
not what he
That's
means.
that's
That's
probably
not what
getting
he
too
means,
conspiracy,
YouTube
and that's not
folks.
what I mean. But anyways, just see, yeah. Well, anyways, it's just to be able to see that consumer demand shift happen for like travel and leisure to goods and services, and now probably from goods and services back to travel and leisure or recreational. It's something. It's something. It was very tangible to see that happen in COVID. So I thought that was very and very interesting thing. We were talking about the portfolios though, right?
Sure.
Should I jump back over to that
Yeah,
real quick?
please.
Yeah,
Okay. Yeah.
absolutely.
Yeah. No, just even though there's uncertainty, inflation, interest rates, it all and geopolitics, just a lot of stuff going on. That creates a lot of uncertainty. Around like what economic activity will be like in the future. The reason I think stocks do have one advantage on on inflation, and or in an environment with the type of inflation we're experiencing.
Right.
And this kind of comes with a disclaimer. What I'm about to say kind of, I'm assuming that, some level of economic expenditure stays current or stays up and growing to make stock earnings function. But stock earnings are actually, they represent a real aspect of the economy. And so what I mean by that is essentially is it's probably likely that companies are in business to make a margin, and they protect that margin, and ultimately, if their input prices rise, their output prices rise.
Right.
And
You talk about these greedy corporations, John. These greedy corporations.
And so, well, anyways, so the earnings, all I'm trying to really express is the earnings that stocks pay, or well, they pay dividends, but the earnings that stocks accrue or earn,
Mm-hmm.
essentially where the dividends come from or the stock buybacks come from, that those measures of value should be rating up with inflation. So
Right.
the return on stocks is kind of like an inflation hedge, I guess, for lack of a better term. But where in contrast, a fixed income payment, the word fixed there is important.
Mm-hmm.
It's locked in for the life of the investment. So if inflation rises, it doesn't mean that the coupon pay or your coupon payment on your bond is probably not rising with inflation. So that's why we view stocks as, or that's why I would say stocks is a better inflation hedge than bonds. And the good news is a lot of our portfolio management today represents that. Now you're
Right.
going to pick a different mix of stocks and bond depending on what your measures of wealth are and what your risk ability and willingness to take risk are. Those a bunch of
Sure.
other factors come in, but at least through our portfolio management, I think we are expressing, or we have expressed through our views, that we were going into we were already in an inflationary, a price expansion environment. And the best way to handle that is to invest with assets that can experience growth, nominal growth with the economy, if that makes sense.
It does. So I just to kind of sum up, it's like if your business has the ability to protect their margin, meaning you can increase prices as your inputs increase, and you can continue to generate free cash flow and grow earnings, inflation is just, you can still continue to succeed in those environments.
Yes.
And the challenge, obviously, with the bonds is that if you're getting a fixed coupon rate, and let's say it's a 10-year note at 3%, then it's 3%.
Yeah.
And whether inflation rises or not, that's irrelevant. And I think one of the, just coming out of this last 2020, 2021 is people were able to lock in unbelievable credit prices, unbelievable mortgage rates. Those are great inflation hedges. There are good components of that. Like we said, we've done the whole business cycle in 2 years. So, we've seen pain, joy, back to a little bit of pain. But ultimately, a well-constructed portfolio can capture enough components of that even in an inflationary environment, we can still have success.
Yeah. Yeah.
Right.
Yeah. Yeah. Go ahead.
No. So, Michael, anything else to wrap up?
No, I mean, I think, well, where I always sit on this specific topic with portfolios is I think your time horizon is like the most important thing, because I've yet to come across any data or research that shows you like, hey, under any and all circumstances, there's a specific portfolio mix that is a perfect hedge against all things. You kind of have to try to, evaluate, like John was saying, what level of, risk and volatility you're willing to, take in the short run for an expected rate of return over your time horizon, what you need the funds for, and then what risks you can diversify away, and then what risks will remain, in black swan type events. Everybody's kind of in the bathtub when it comes to that. I mean, we hopefully you can can plan appropriately. But that to me is the bigger thing. And I agree with like what both of you are saying. Equities need to be looked at for what they truly are, which is you are trying to have shares of ownership in the biggest and the best companies in the world. And I mean, whether you like Apple and what they do and Tim Cook, what they're trying to figure out how to still sell their products in this environment, and Microsoft doing the same thing. And, Elon Musk is still trying to figure out how they can sell Tesla vehicles and get their orders out. And so these are people that are all trying to figure out the inflation equation, just like us. And if you are owning, equities, or you have exposure to these companies through funds or index funds, then you're part of that. You get to participate in that as well as an equity owner. So I think that should not be discounted for folks as they are looking at being an investor. So yeah, this is always a fun topic because there's just so many different angles that we can't approach it from. But I think, definitely it's always great to hear, the mind of an analyst and how they evaluate certain things.
The
And so,
mind
Jon,
of an analyst. There's an analyst on the podcast when you start diving into interest rates and liquidity in the credit market.
My new favorite word.
Well, Jon, we're sorry we don't get to bring you along on all the lighthearted conversations where we just talk about little financial planning topics. It's like, all right, we have Jon on. Let's go dig into the yield curve and where we are with the credit market. So appreciate you lending some insight to our conversation here to bring a little data and analytics to it.
You're welcome, and I'm thankful that you would choose me to come on. So
of course,
appreciate you too. Yeah.
Well, we want people to know that like it's always funny when one of the most common maxims in investing is don't just do something, stand there. And a lot of times when markets are volatile and things are scary, I mean, somebody posted online a whole thing about the collapse of the dollar, just hyperbolic takes are just taken over everywhere. But I think it's important for people to understand like that there are professionals working on their behalf that are constantly, chewing on various different pieces of this puzzle and looking at data and trying to analyze it so that they can make, appropriate portfolio decisions, which then, goes down to the advisor, who's trying to advise on how to invest funds and then what are the best portfolios to, help people accomplish their financial goals. And so it all works together. And so we do appreciate you, man. Of course, we'll try to get you on here again where we could talk about Michigan State football or something fun. But, in the meantime, we appreciate you, buddy.
All right. Thank you.
Cool. Thanks for joining us, Jon.
You're welcome.